And again, you're joining us here, Chris, just about 30 seconds to go, actually, before we get our consumer confidence numbers this morning. I don't know if you heard what I was saying just a moment ago, Chris, but to me, the consumer is really important right now. In fact, arguably, in my opinion, more important than even what the Fed does, as long as they're still going to cut rates at some point. Would you agree, or do you think the Fed is more important than that?
No, I think right now the market needs other reasons to justify up. The Fed story is kind of played out. I'm still a little confused with why the market so desperately wants to see rate cuts outside of the fact that maybe it's priced in so many good things that it needs the cuts to justify why it's ripped and gone the way that it has. Because historically speaking, when the Fed starts cutting rates, those cycles usually mean tops. So
Sure.
this would be an interesting time to see that. But I think right now the consumer is stretched. We're at all-time lows in affordability for homes. Inflation's trending the right way, but it's still sticky. The consumer is pulling back. We've got household debt, and I don't know, maybe the consumer is on paper probably healthier because everyone has more like household equity.
Sure.
But unless you're going to cash in on that, unless you're going to sell your house, unless you're trying to sell high and buy high,
Or
I do
sell your
think that.
stocks, one or the other.
So I mean, so it's like you've got to clear some assets up to like kind of keep the lifestyle going. So I think that's the concern. But at the same time, I mean, I do think the top echelon, it's like they might cut back on retail, but if you look at hotels, travel, flights, TSA numbers, like people are still traveling. I think it's more maybe the consumers switching from retail goods to travel, tourism, leisure, like experience goods. That makes sense.
Yeah.
So I think they're still spending, but yeah, I think the consumer is really important because are we going into a consumer slowdown and an economic slowdown and
Mhm.
an election year? So I mean, there's things that could certainly snowball into making things way worse. So
Yeah, I mean, I'm kind of in the camp, Chris, of like, I would like to see. By the way, for those of you wondering about the consumer conference that just came out, it came out pretty much exactly as expected. That is why there's not of any volatility. It's like playing the news and they're just talking about like a local, art festival. Like it's not very exciting to participants, just like watching the news and finding something boring on it wouldn't get you to turn the TV on. That's just my analogy for basically news was not exciting enough to get a big move going. Came out exactly as expected. But yeah, I mean, Chris, to me, it's like the consumer, matters because it really, when I say consumer, I'm talking about, data in general, like the labor market as well. Like
right,
if we see a continued trend where inflation stays hot and, labor data continues to accelerate lower, like cool, that's where I get a little bit concerned. But I would love to see the consumer stay relatively strong and labor data to kind of cool at a mild rate, but really what unlocks the next bull market high for me or like wave higher would be inflation finally having some progress. Cause then I think that's what a
yeah,
lot of the bears would point out too. That's what they're concerned about. Would you agree?
I do agree, and I you know the next move higher is capitulation. I
Mm-hmm.
think that's the blow off top that even we thought we have had like this bull run, but I think the next move that is higher, if it's going to be higher, is going to be like this scary high move. Let me I know I'm not sharing my screens here, so let me go. I was just getting a futures trade in for the Russell. Let me go SPX right here. So I still think that we could be entering into a bit of a summer slowdown. So let me throw my screen up here, Nick. Summer slowdown would make some sense just based on the seasonality. I think we talked about this on the show. It's been like since 2018, 2019 since we had a sideways move, and here we are looking at, everything's been pointed up, everything's been bullish. Nvidia's kind of come back to a reality. It shed about $300 billion in market cap over the last 3 trading days, which is kind of wild. You said you want to buy this thing 80, 90,
Like
100?
95 is what a level
Okay.
that I had on my thing.
Okay, I put in ratio spreads on NVIDIA to try to get a 95 long put with an 80 sell put. So I'm doing ratio spreads where if I own it, I'm going to own it like sub 80, which
Oh
again
yeah.
might be really, really that's asking a lot from the market. But I'm going to set it. It was volatile enough that I got a decent credit for it. So we'll start there. And then I also took profit on NVIDIA from a trade that I did with Frank last week. So we did a short-term trade that was out to this Friday. That trade took profit. I've got another one out to August to let just NVIDIA volatility hopefully kick things around for a couple of bucks. So if we let's just talk sideways. Let's say the market right now is kind of topped out. If we don't take out the April lows, and let's say we chop around here through June and July, it would be understandable that we're going to have a little bit of indecision. I think what gets nuts is a blow off top that brings in 6,000 plus in the S&P or 600 on the SPY. That's going to be what everyone should be happy about because it's going to be great for the portfolios. But that makes me a little terrified to see what that looks like 12 to 24 months later.
Sure.
So,
Yeah, and that's the big question is, when I was talking about NVIDIA earlier too, I was saying like what I think is healthy for the market would be a bigger pullback in NVIDIA. I
yeah,
think like this like small leadership in the market is not sustainable. It's not like healthy in the long term to only see. And yesterday we had really good signs of some broadening out, which I think is great. Like I'd love to see NVIDIA take a
yeah,
breather, but then let energy and utilities and financials like have a little bit more of a squeeze higher. Like let that lead for some time. And I think that would be again very, very healthy overall.
yeah. Let me ask you a question. So, this growth to value, statistically, there's some interesting takeaways. So, the last time we had a big outperformance by value compared to growth, it would have been post 2000 bubble. So when we got into value was getting just hammered by growth, but over like from 2000 to 2006, value outperformed growth like 87% to negative 10% or 15%. The
Mm,
problem was neither one were really that positive. It's not like value became like the greatest thing ever. Some value was great and it kind of sustained the portfolio. But remember, if you're in a down market like a 2000, 2001 or a 2008, 2009, or 2007, 2008, if you're going into a down market, very little is safe. So, I mean,
yeah.
if you're going to be making money in a bear market or a down market, you're going to have to be bearish. You can't just play defense and play protection and make money. You can not lose money, which is obviously great, but
Right.
you have to play like aggressive defense, or take the offensive on the bearish side to make money in a bear market, like a Druckenmiller or somebody a little bit more that's really made a career out of like heavily leveraged asymmetry when it comes to bear market. So that's a tough
Yeah.
camp to be in, obviously, I think. But I'm just curious, like, do you think that we are so entrenched in tech and so entrenched in growth that value might never be the same?
Y- You know, I think that in terms of growth versus value, it's a really interesting conversation. And I just wanted to also touch on that point you made about like you cannot like out defense a bear market. There's
Hmm.
just no way because
Hmm.
what Chris is pointing out for those of you guys who may not have caught the full like the great point that was made there is that if you go look at any like traditional asset, bonds, stocks, growth, value stocks, everything except for energy and the dollar in 2022 was down. And
Hmm.
some things were down horribly, some things were down a little bit. But even the Dow Jones, if you had just said, I want to stay in the Dow, you're still down. Like I think it was like 12 to 15%. It might have been a little bit more than that. S&P was like down like 25 and the
Yeah.
NASDAQ was down like 38. So that's 2022 as a recent kind of example. But the frustration about a true bear market is that everything becomes very, very correlated. And it's really frustrating because it's like you can't hide in a real bear market, in a real sell-off. Everything gets crushed barring depending on the situation, bonds can be a safe haven, but in 2022 they were certainly not a safe haven
Hmm.
because it was rate hikes to oblivion that caused the concern. If you get a bear market on just a straight up consumer really really struggling, then bonds are probably going to look really good because in that case, then you have inflation really low and you have like a consumer just tapped out and unemployment skyrockets, then the yields that are offered on bonds today may look really good. So maybe TLT or something like that can help you hide out a little bit, but it's hard to avoid a bear market and the tough sides of that. I think that, as you mentioned, you can get aggressive. You could start, if you're active, you can look for shorts. You can look for tactical, defensive, conservative shorting, because it is very difficult to do. But adding some sort of hedge as well is another way of doing it. Another way that I personally like to do that, Chris, is like, let's say you do get that blow off run higher in the market. I personally like to sell some calls. I feel like that's like a kind of middle ground, to sell calls against some of my positions. There are ways to get constructive with it, but unless you are outright looking to short in a bear market, it's really tough to avoid the difficulties of that.
Yeah. So I'm going to throw a hypothetical out here. Let's say that the SPY actually gets to 600. Let's say it gets there this year. So let's say we have another, blow off move, capitulation move, post-election Q4 rips like it did in 2023. It's the best thing to be long. If I wanted to position for a correction, more than likely, I'm going to have to pay for some time on that. I think the cheapest way to do that would be looking for out of the money puts, but long puts at like that 5 and 10 and 15% correction area. I don't know. I mean, I don't know what it prices out to be right now, but I'd be willing to probably throw, let's say, $5,000 on $100,000 account, throw it at some out of the money puts that have the potential to pay me 3, 4, 500%. That is a little bit of defense. That I'm not all in. I'm not all bearish. I mean, there's ways to be bearish in the market without actually taking a short position. There's ways to be bearish in the market by trading. I mean, inverse ETFs are not my favorite, right? But you can do like sector. You can do like again, it's kind of sector rotation, or there's the single leverage inverse ETFs, which aren't as leveraged. There's no like backwardation contango on those, which is just a fancy way of saying they're priced for short-term trading. So if you do like a double or triple leverage instrument, they're not meant to be held for any type of duration outside of like day-to-day or week-to-week. That's about as long as you want to go on trades like that. But if it's single leverage, it's just inverse. So as an example, I think SH is the inverse of the SPY. This should be a single leverage. Yeah, so this is ProShares short. This is a single leverage. So if I was long the SH, that is essentially like being short tick for tick of the SPY. So if the SPY goes to 600, I don't know what the price of this instrument's going to be, but it's probably going to be, let's say it's $10. Okay, well, if I'm long at 10 and it goes to 20, are we going to have 100% position on the SPY? I mean, no, like the SPY is not going to drop all of that. So again, you don't have to be short per se, but there are ways to trade a bear market. I just think that right now we're not in one. And so let me throw one more thing at you. This is really weird. I talked about this yesterday. I think this is something. So I mean, this kind of goes down the rabbit hole that I started looking at an edge finder when I'm looking at that. The average 24-month, 3-month, and 10-year yield curve inversion, right? In October of this year is going to mark that 24-month average where we go from inversion to recession. Not saying that we have to, but I really do think that if Q4 of this year cannot carve out a gain, I'm really concerned for what 2025's performance looks like. Just so the yield curve is part of it. And also, have you looked at the, if I throw on a comparison here to the Fed funds rate, I'm going to throw on the Fed funds as an overlay, and I'm going to do a new price scale. So watch this. On a weekly time frame, notice some of our biggest corrections in the markets and when they happened. Fed funds rate cut, down, rate cut, down, rate cut, down. Here we are.
Rate cut.
I mean, that's what I'm saying. It's like, why does the market want a rate cut so badly when historically it is terrible for the stock market?
I mean, it's just there are like 1995 on your chart there. Go back to Chris's chart for a second. That's the one time in that recent history where
cuts,
you did get rate cuts, and it was gradual and it was controlled. But if you think that the Fed's track record for cutting rates and keeping the economy completely stable is good, then I would screenshot this, I would mail it to you, and I would sign it personally. And I'd say, send it back to me with a letter in the mail and let me know. But you get my point. Like it doesn't have a good track record of cutting rates and not they keep saying we're not going to wait for the economy to break in order to cut rates, but they
Right.
always do wait for the economy to, they say themselves that they're data dependent. They're always going to wait for something to break uh,
Mm-hmm.
to really get serious about rapid rate cuts. Those drops, I was talking to my dad about this recently. He remembers, I wasn't really trading. I definitely was not trading in like 2000 or 2008, but he remembered, during those times, I think we were on vacation for like the 2008 one. And he was just like,
Okay.
it was just Fed emergency calls,
Yeah.
like emergency meetings. We're cutting rates.
Yep.
Emergency meetings.
Yep.
We're rate cut rating. Like when
Yep.
rate cuts start, the
Mm-hmm.
question is, where do they stop? And that's the scary thing that I think
Zero.
people are not ready for. Yeah, they stop at
Yeah.
zero, or you become Japan, you go negative.
Right. Well, so one now that we're talking about this, this is one thing that I do think is it's a slightly different look than what these are. Right. You go from this
Mhm.
peak all the way down to like emergency levels where that's the Fed breaking stuff or the market is breaking and the Fed's trying to step in to backstop it.
Yep.
This is again, I don't know, but when we're talking about if you look forward on the CME watch tool, you look forward for the next 1 year, it goes out to like September 2025. By the time we get into 2025 or end of the year 2025, we're only expecting like another 100 basis points or maybe 150 basis points. So that looks like the 90s because when this was going up, this only went, I mean, this is my Fed funds rate over here. We're sitting around like 6% and we get down to about 4.5%. That
Yeah.
seems like a reasonable cut cycle, not an emergency cut cycle.
Right.
So if there is any way that the Fed can go from 5.5 down to about, let's say, 4, and do it in somewhat of a calculated stair step type fashion instead of just straight up like we're cutting every quarter or we're worst case would be like we're cutting 50 basis points or 75 basis points
Yep.
because it's now they I don't know and that's what is alarming is like the Fed is rarely getting all this stuff right. We're looking at this chart, which is every time we see a cut cycle, it's usually terrible for the markets. This is the
Mm.
one time in 30 years
Yeah,
that
and
we've
again,
actually
Chris,
seen
it's
like
like
the market actually goes up.
if you get a rate cut, and what they say next is we're going to take it very slow, maybe skip a break, take a break, cut, skip.
Sure.
I'd be like, yes, yes, this is good, because then
I
it
would
looks
too.
like that chart is if you
Yeah.
see. Again, I don't cheer for rate cuts, and I have not cheered for rate cuts since this entire year.
Yep.
When things were getting really bullish, this is when I was the most bullish all year long, was when I was super long the Russell, because let me show you here. So in the 10-year yield during November and December, I went just absolutely, I mean, appropriate risk, but I had huge positions for my account all along the S&P 500 and the Russell. That was like my entire
Mhm.
account, was those two things, because during this time we had a beautiful combination. We had yields falling and unemployment not moving. We had jobs data looking strong. And that combination looked 1996, 1995, because then you have, again, cooling in that inflation problem. Maybe it was just supply problems and now those are resolved and now inflation can kind of come down meaningfully while
Mhm.
we still keep the economy. But then where I've gotten more cautious is post that period where inflation rounded off. And at the same time, we have not seen much from this point. We have not seen a lot of progress in inflation on a year over year basis, but we have seen the economy show some signs of slowing. The consumer under some stress, and labor data materially trending lower. Now, labor data is not at a bad point. Somebody made a really good response to my point on this, and I'll show somebody responding really well to my criticism of labor data. And they said, Nick, before you get all bearish on that, this is just resuming back to pre-pandemic levels on the job
Mhm.
openings. So we take a look at job openings. Nick, you're saying, oh, it's trending lower. That's bad, but it's still above pre-pandemic. I'll give you that. That is a
Good point.
good sign.
Yeah.
But look at the direction here.
Mhm.
Inflation, if blue is inflation, inflation is sideways.
Yep.
Labor data is down. If that doesn't change, I think we have a problem. That's where I think you start to see, the labor data if it gets too
It's too
poor,
much. Yeah,
it'll
it's too
drag
soft.
inflation lower for the wrong reason.
Yep. Yep,
So
and that's, I mean, if we don't have consumerism, we don't have growth, then you're arguing about the stagflation type
yeah,
environment, you know?
exactly. Which is why I'm just such an obnoxious gold bull in the last few, months. Is like I just
Yeah.
long. Oh, also, Chris, I took two positions. I went long silver, not
Okay.
going very well right now, but I also bought Bitcoin yesterday. Just a little bit of it into my account on a weekly chart. I liked the level here, hit
Okay.
support. Um, I don't know. I think Bitcoin, the utility of it, every year that it goes by, that it doesn't get wiped off the face of the earth, to me is more bullish. And I've also made the stake earlier in the stream that I think that your risk reward on Bitcoin is good because I'm risking 100% of what I put in this. I'm fully aware that that could go to zero.
That is the play, man.
Gotta
But
accept it. But
if risk
if
capital,
it
yep.
becomes a thing, you quadruple, you 10x your money over time. I feel like it's a good risk reward. I could be totally wrong. I'm not a crypto Super Bowl or anything like that, but I like
Mhm.
the risk reward. I like the history of at least it comes back every bust and comes back really strong. And I think we could see 100K Bitcoin. And this is coming from somebody who is kind of skeptical on this sort of stuff. So I just
For
think that
sure.
risk reward rise, it looks decent right now. So just wanted
Yeah.
to share my thought on that.
Yeah, no, I agree. From my charts too. I mean, I think that this 60. I mean, it's right at the level I said it needs to respond. So I said between 60K and 56K. That
Mm,
is really the true test that the bulls are still here.
I
I
agree.
could see this. I mean, this reasonable run that we've had, poking the all-time highs, creating some sideways movement. We're coming right back down in just this steady fall. If the bulls are going to step in, this is the area, and this would be that, okay, those bulls are still out there, alive and well. Let's say we get back to the 70s. Cool. I mean, we can range on Bitcoin, and I'd be fine with that. But
Yeah.
what would be really concerning again is like, do we break the structure? And if we
Yeah.
did, that would be here's what I'd want to see. We'd have to see a bear trap. If we break
Mm.
the structure and we rip back up here, that's the low, and this thing now has the
Oh, yeah.
traction to maybe
Yeah.
be ripping higher. But if we just come back and we responded, I mean, I said 60K to 56K, we came to 58. It's right there, and if it holds, this is still pretty healthy, even if it's sideways. But you're right. I am like right now. I did this in a little session yesterday. I mean, I was very fortunate that I was not interested in crypto until after we had the failed attempt to hit $20,000 back in 2017. When we had that crazy run, I looked at the charts for the first time during that year in 2017, and I said, "Man, 3,000 would be a great level to get in." It was perfectly technical. It was right around that 61% fib level,
Yeah.
and the darn thing went from 30,000 or $3,000 and change to 20K in like a 6 or 7 month period. But
Yeah.
that's when they created the futures market around it. So that was as
Yeah.
soon as that happened. They failed at 20K. They came all the way back to where they started. And so that reset is where I started to dollar cost average. And so I've been very fortunate as a trader that I started participating in Bitcoin around 5 or 6K and around 3K. And then that first big run where we broke 20 and went up to 60. I mean, this first run here, 60 to 64, I was out on those gains, and then I
Yeah.
reset. So, I mean, I again, trading wise, I've been very fortunate to make some good profits on crypto. I'm looking at the same situation now at all time highs. I mean, my cost basis is probably in the 20s,
That's
which I
amazing.
still I wish it was in the threes or the fours like it was
Yeah,
before. But
sure.
when we got to 60, 64, I'm taking profit, and I did, and then I reestablished back down here at 30 and change, waited for trend lines built in around 17 or 18. And so right now it's probably in the 20s as my cost basis. But if 20s gets to hundreds, that's a 5x return. I'm a
Yeah.
trader, dude. I'm going to take some profit. I'm going to take some cash off the table and maintain a core position. That's really what I look at it like. I'm not
Yeah.
all in. I'll never be all in because as that
Right.
profit grows, I don't want to be all in. I want to take some
Sure.
cash. I want
Well,
I
yeah,
want to
and
trade
you
invest
don't
in other
want to
things.
let it become, for me, this is aggressive sizing, but I have 3% of the portfolio in Bitcoin. I say that's aggressive
Okay.
because that is aggressive. If you're,
Sure.
imagine if you're, money managing and you say 3% of the entire account is in Bitcoin, that's big. But
Yeah.
just a quick story on that.
But it's only 3%.
Yeah, so 3%. But as you mentioned, if it became a ginormous position, if it tripled and it became like 9% or 10% of my
Yeah.
account, it's
Right.
time to trim it because that's
Yeah.
not
Rebalance it back to
yeah,
3%. That's
exactly.
totally fine. Yeah.
So, well, I just quick story on Bitcoin too.
Okay.
In like 2000 and I think it was like 2019 or something around that time, I was sitting in Frank's basement and we were watching a movie. And Frank and I grew up together, so I'm over at his neighbor. You know, we're neighbors, so I go over to his house and I'm hanging out with him. And I decided while I was sitting on the couch with him talking about Bitcoin to buy some Bitcoin at 9,000. And I let me see, when did I do this? I can't remember exactly. I think it was 2019. Well, when it ran up, I think I sold it. And I should have just left it in there forever. I mean, shoulda, coulda, woulda.
Sure.
But
Sure. Sure.
um, actually, I think what happened is I actually held a lot of that during the craziness and I sold it after it crumbled back down because I kind of lost my faith in it. So I
Ah,
literally got played
yeah,
like a board game. But you know, I have made money on crypto. I've not lost money over time, but I have certainly not played it perfectly. But I think for me, it's like if it's going to do another cycle, I have no idea if it's going to do another cycle. But
sure.
the rumor has always been Bitcoin to 100K and beyond, and if that happens, um, let's peel it back. What's actually going to get a Bitcoin to 100K? It's not the crypto crowd. It is the
Is risk
risk
appetite.
sentiment of the market. If
Yep.
markets do a melt up like you're talking about,
Yep.
I'd actually rather if you told me, Chris, in the next 3 months we're going to have an absolute melt up, SPY to 600. If
Hmm.
that's what's going to happen, I'm buying Bitcoin. I'm not
Sure.
buying, you know, if I knew that was happening, which I don't know it's happening, but
Sure.
if I did, that's what I would do because crypto does really well when risk sentiment and consumers are doing well. So,
And if you talk
yeah,
about that, it's like let's say we melt up. Okay, let's compare the percentages of a melt up. Let's say that Bitcoin from 60K goes to 100K. That's a 61% move. Let's
yeah,
say that the SPY goes from 543 to 600. It's still a good move, but it's not nearly as impressive, right? So
sure,
yes, there's more risk there, but we get to 600. This is SPY. 600. I mean, that's a 10% move. What would you rather take? A
of course,
60% move or a
right,
10% move? It's a no-brainer. So, again, for the same dollar allocation, that's what's crazy about, just gains and earnings is like $1,000 invested versus $10,000 invested versus $100,000 invested. It's the same time, the same movement, the same, the same requirement in the underlying asset. But it helps to have a little bit more capital. It helps to, if my 3% allocation to Bitcoin is 50 grand, that helps
sure,
if I
yeah,
have that
of
much in
course,
my overall portfolio. But if my 3% is, $3,000, okay. I mean, it's still properly balanced and it's still risk capital. But again, same thing is true. Like, look, if we have a melt up, couple exciting things. I'm going to be long Ethereum, long Bitcoin. I'm going to be long to Russell, and I mean, probably long the SPY and the Qs as well. Like, I will be long everything, but I will also be protecting pretty aggressively going into the turn of the year, going in
yeah,
to play some defense going into 2025, just in
yep,
case. Because that would mark, and look, we can stare at this chart. I know my chart's messy, but just see through the nonsense with me. We've talked about this. I mean, technically, I could see a case for 600 plus. All it is a channel. That's
sure,
all it is. And what we don't know is if we hit the top of this channel, Nick, and we fade and we come back to the halfway point of this channel, or we fade all the way back down to support, we don't know what combination of garbage that's going to be, right? Is that a war? Is that Trump? Is it a new presidency? Is that the consumer failing? Is that bankruptcies and delinquencies and all these things that have been bubbling under the surface? It's like all these things. I mean, COVID is a good example. COVID should not have been the reason that the market dumped in 2020, right? The market should have been bearish in 2020 because we had other stuff happening. We had another Fed backstop that was, a debt fueled rally that was artificial. And um, I mean, I don't know how COVID all of a sudden is like, that's why the market crashed. Well, yeah, the reaction to, I guess the global reaction to COVID is like, yeah, it definitely changed some stuff, but it didn't sustain anything outside of a month or two. Like
right,
that was, I mean, you had mentioned, the Dow in 2022, the Dow was down over 20% in 2022. Everything was down, 20 to 35% within a month. And that's scary, but it's like, yeah, we somehow faked our way out of it. So I guess the hard part about these markets is do you think that these markets will truly move without the Fed?
Yeah, and that's the question, because it's a tough one to say, because right now every dip gets supported by tons of money printing, and so we don't
Yep.
know truly what, um, without money printing, what the market would look like. I think that you still would have certain companies that are powerhouse players, but you'd have a lot of stuff that would really struggle without. The Russell has gone nowhere if you didn't have the potential of the Russell flying high on rate cuts and a growth cycle again. Then yeah, the Russell would probably be lower for the next year or two. So we'll
Yeah.
have to see what that plays out going forward. Chris, I'm gonna back out here. Frank's gonna be joining you in just a few minutes here.
Okay.
Before I step back, let me just let everybody who is watching know, if you guys have not already subscribed to Chris Pulver on YouTube, there it is, at Chris Pulver Trading. And if you're watching here right now on Twitter, it's at Real Chris Pulver. You can find his Twitter account there. Keep up to date with him. And Chris, thank you very much for taking over the show. I'll leave it with you guys to go from here.
All right. Thanks, Nick.
All right. See you.
Take care, man. All right, Frank will pop on here in just a moment. So yeah, interesting conversation on the Fed funds rate, the timing. I don't really know the ramifications of why the market is so desperate for a rate cut outside of, yes, it's restrictive, right? It's restrictive with borrowing, it's restrictive, and it's hurting the housing market. I mean, let's just make a small list here, and then when Frank pops in, I've got some option stuff to talk about with him. So let's do this. So high rates, right? I think we're in this. I mean, let's say the consumer has been kind of conditioned for lower rates. I mean, as I'm trying to think, I mean, my adult life, let's say for the last 15 years, uh, you know, going into big decisions like buying a home, selling a home, buying a home, selling a home, trying to refinance on a home, trying to consolidate any type of debt or loans. It's buying a car, financing anything. The difference between what it was like, let's say, 5, 6, 7 years ago, or obviously during 2020. I mean, consumers aren't stupid. I mean, if I have a house at a sub 3% mortgage, and I look on the market right now, and the average 30-year mortgage rate's at 6.5 or 7%, the consumer's not dumb. You can do the math, and you can realize, like, holy crap, that house is unaffordable. In addition to house prices being more expensive, so I think that this is where the pressure on the cut rates is happening, because the consumer is being squeezed, and it would be a little bit of a relief for the consumer. So maybe a rate cut, if we see it in September, or see it by the end of the year, September, December. I think that's what the market wants, and the watch tool still reflects that. But if it does offer a little bit of relief to housing, more supply, more demands, better for the consumer to try to get their finances in order, maybe that's what helps kind of fuel a little bit more than just earnings, interest rates. Because like I said, that chart that we showed, I'm concerned that cutting rates to like emergency levels it's never looked good for the last 30 years. It's never looked good. So anyway, Frank, what's up, dude? Let's chat.
Hey, Chris. Happy Tuesday.
Exactly. Happy
Thought it was
Tuesday.
Monday for a sec.
Well, we got a pretty quiet day thus far. We had this is my Tuesday chart. We're still not below last week's low. We're still not above last week's high. We're still kind of contained. I had mentioned last week that we have some potential evening stars setting up on the weekly time frame. Here is the SPY, and I think it's the Qs that look so good for a potential evening star. So this would be a nice little wick right here. So we have decision bullish, indecision bearish, and if this week, and I don't know, I mean, it is the end of the quarter. We do have some data this week. We have US GDP, we have core PCE. I don't know if that's going to be enough to spark all this volatility. And also with an evening star, it doesn't have to be 3 candles. You could have an evening star that you have decision, and then indecision, 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 and then decision. So we could have something like, maybe it's not this week. Next week is a holiday. Maybe it's post July 4th. Maybe it's post holiday trading if we're going to see this thing, carve out a top and correct a little bit. So anyway, just thoughts on that for where we're at. You still looking for a little bit more mounted pressure to the downside? You want to see things go lower? Where are you at?
Yeah, I think just judging by the last 3 days, that to me doesn't look like it necessarily wants to go higher right now. I
Hmm.
think this is kind of how it starts. Is this little they are 3 red days on the SPY, but I think that you know before that sell off happens, like you said, where it's indecision for a week or 2 weeks
Right.
or however long.
Yep.
Um, I'm looking at the daily chart, and it always starts out with that little hesitation, and if price doesn't return back up to where it was, like I think it was 55, yeah, hit 5,500, came back. That was like the price target for June. Um,
Hmm.
I don't, not really sure if it's going to come back to test that by the end of the month. Um, and I'm kind of thinking that this is where it starts to pull back, and that would be fine. I don't think it's going to be like a giant one, but I do see, the market is due for some kind of retracement because every time we
Sure.
have a steep run, there's some hesitation. It comes back up just a little bit to test, then it dips lower. We have a long-term trend line on the daily, so it's not anywhere near that right now, but
Right.
um, could come down there. I'm thinking we have more room to run on the downside than the upsides. Like even if we do go higher, um, we are we are not that far from the highs. And Nvidia, I saw that their vice president stepped down, and insiders are selling, and there's some rotation out of these speculative stocks,
Hmm.
and they're going into blue chips. That's why Nas was falling yesterday, and the Dow was up.
Yep.
And I'm just seeing less demand for the Nvidia trade, and I think it's just AI in general has had its run, and there's nothing wrong with taking profits here. And I think that's just where people felt comfortable keeping, taking what they have off the table for now, or at least
Sure.
trimming. So I don't think this is like a indication of a strong pullback, but I think it's just due to see like a couple percentage points down, which would be fair, and then it would give investors or traders, I guess, another opportunity to get back in. But right now, I'm not really seeing heavy upside potential because I don't know any news coming out. I
Hmm.
don't know what could drive this higher unless it's just a lagging effect of the AI trade. And then consumer confidence was like the biggest thing this week from what I saw, and that was pretty much as expected. We saw slightly above what they forecasted, but lower on the month. And then if you look at January's number to now, it's a steady decline from like 114 to wherever we are now, like 100.4.
Hmm.
So the confidence is slowly declining. There's a lot of things just playing in the market that are not exciting for optimism. So I'm not really looking too bullish on the indices for now, but if it's a slow week, it could just drift higher. So that's kind of where I am right now.
Yeah, I mean, I think it's drift. I think it's sideways. I mean, just on the subject of video for a second. I mean, if you had any ounce of timing in 2023, I mean, it doesn't have to be much. In whether if you missed out on like the 2022 correction scared a lot of people. I mean, personally, I had clients that were very nervous about 2022. And we're I played a lot of defense in 2022 and still just carved out. I mean, if it wasn't for forex, 2022 would have been an insanely hard year. 2022 was a heavy inflation play for me early in the year, so my first half was really solid, and then the second half was holy crap, man! I'm just trying to like break even in my stocks and options portfolio, but currencies really helped me. Like currencies helped me get back to overall net positive on the year because there were such big moves in currencies in 2022. But the Q4 timing of October 2022, let's say that you just forgot about 2022 and you just started to participate when the market seemed like the coast is clear in 2023. Well, Nvidia all by itself, just from let's just pick like a random spot here in January 2023, 660%. So I mean, Frank, if you had even just a 1% stake, a 2% stake, let's say a 2% stake, that's enough to get you, 12 to 14% in your entire portfolio over a year and a half on one position. That's how good it was, right? If you're in the S&P, you're looking at that at, that the S&P is broadly, I don't know if it's, I don't know the exact percentage, but I want to say like 30+% of the S&P's gains over like Q4 last year to this year, 30+% of those gains have been NVIDIA related. That's because it's just gotten larger, and it's, it tapped the 3.4 trillion dollar market club, became number one in the world, and then quickly shed that. But it was enough to drive it up. So you can see where profit taking would be pretty important, and maybe a rotation into the Dow. And that's another like balancing point of like, we had the Dow, the Russell, the NASDAQ, and the S&P all doing pretty well in the broader bull market from late 2023 into this first Q1 this year. Now it's a very disconnected market. S&P and Qs, right? SPY and Qs have dragged higher, peaked out a little bit. You hit the SPY at 550. The Qs dragged up there towards where were the Qs highs? Qs highs popped up there around 487
for the NAS at least.
Yeah, the NAS was it tapped that 20,000 mark, right?
Yep. So just big psychological levels.
Yep. So a huge round number there at 20K. So yeah, look, I mean, we've had a lot of trends for a while, and a little bit of pause would be okay. A little bit of a correction would be okay. Again, the SPY, maybe you know it, Frank, but guess how big this recent correction has been. By correction, I mean like a couple of gaps lower in the last week of trading. How big do you think this is? Don't drag it. Just try to guess. Based on what the market's been doing for the last, 6 months, 9 months, what do you think this correction is?
Lower than 5.
Totally lower than 5. Dude, it's been a 1.4% correction. So this is nothing. 1.4%, and the market's like, buy the dip. Where's the Fed? Cut rates. It's like, chill. This has room to get to 3, 4, 5%. This has room to be 7 to 8 to 10%. So it's just funny how, one down day, it's like the market's looking for emergency everything. It's like, why isn't it going up? But again, you've conditioned investors to think like everything has to go up all the time, and when it's not, what's wrong?
Yeah,
so
I don't think cutting rates is necessarily good either.
I don't know. I don't think that it is. I don't love that it is, but like I said, I feel like the pressure is, this is an election year. And I also think, and again, the job of the Fed is not to be political. I'm like moving out of the camera here. I was getting real comfortable in this. We're gonna have a talk. No, but I think that this is the cut will be to satisfy the consumer need, because I think a cut lets, small business see a little sigh of relief. I think it lets housing see a little sigh of relief. I think it gives a little bit, it takes away some of that squeeze and pressure on the consumer. I think that's where the cut is the most beneficial. Now, whether it's the right timing or not remains to be seen, because let's say that they cut, and let's say that inflation gets worse. Well, then it was stupid to cut rates, right? And now the Fed's going to be backpedaling and maybe stuck in a cycle that they don't want to be in, because the market's like, oh, they're cutting. I don't know, but I do think for the consumer, a cut would be helpful. I'm in a position right now where it's like, if I want to buy a home and reestablish equity, I'm not excited about buying a home at 6%, 6.5%. I'm actually literally considering renting just because of that exact reason, because I don't think interest rates are going to go higher. But if I'm waiting for 12 to 24 months, let there be some supply that catches up. Let there be some rates that come down by 100 to 150 basis points. Could I buy a house that I like at 5% or less? Maybe. Are prices going to go up that much in housing in the next 12 to 24 months? Probably not.
I don't think so. If you were to buy a house now, you could always refinance later on, or you could try. I don't know if this is a good idea, but
you buy it over stretch.
Variable mortgages. If you're expecting these rates to come down in the next 5 years,
that's true, and maybe variable's better.
I don't like looking, or the idea of buying a house right now either. Not that I'm anywhere near that, but just seems it seems like a really bad time to do that.
Yeah, I'm looking. let's see. I mean, we're 30-year fixed at it's like, dude, 7. Like, look, I'm selling a house that we closed on for 2.72. I mean, if I knew that, okay, 7.02 divided by 2.72, that's 2.58 more. If I just take my mortgage payment, okay, a mortgage payment at 2.5, so 27.99 times 2.58. If my mortgage payment jumped from, $2,800 to $7,200, how does that look for me as a consumer?
Is there a
That's
way to
terrible, dude.
invest in mortgage rates? Is there a
There
way to
are ETFs that invest in mortgage-backed securities. Yes, I can find them. I've got a list of them that I was interested in as well. But the problem is the trouble that lies in those type of instruments is if we start to see more delinquencies, more lates, more defaults, more foreclosures. Just like, I mean, again, not that this is a revisit of 2008, but there are troubles with those, right? Like those that go bad have to be repurposed into, it's going to be like your collateralized debt obligations. Again, it is like the same language that we learned from these derivatives in 2008 are still here 15, 16 years later, just different terms. And under the surface, it's just a little bit more strict and stringent on how those loans are actually getting repackaged. So, but yes, there is a way to do mortgage-backed securities, and there's a way to be in the Fannie Mae and Freddie Mac and those type of instruments. So, yeah, let's talk about that offline because it's not bad, but I don't know what the upside is outside of you're investing in housing. It should be pretty stable, should be pretty safe, but it is until it isn't, right?
but yeah, if we could do more research on it, because I'm curious to see what the delinquency rate would be now versus, I guess, a few years back, and then
Sure.
if it even is a concern or not right now. But I think the longer that rates stay this high,
Hmm.
especially with how expensive housing is, um, it's probably something like that could crack in the future. But if
Yeah.
it's not there now, then I think it's still pretty stable to have. That's a 7% mortgage rate. So if you could somehow invest in an ETF that would pay you a dividend similar to that, that's
Yeah, but I mean, that's
pretty
scary high because that's going to be. I mean, if you're getting a 7%, that's equivalent to like a junk bond. That's high risk. So I would say if you're doing MBS, you're not going to get the 7%. You're going to have the servicer or the creator. Like you're probably going to get a safe like 2 to 3% yield on that. But you're looking at price stability. I don't think you're going to get 7%. So like I said, let's do some digging on that and figure it out. Frank, I want to talk about something with some options here. So as much as I want to get crazy on like, yeah, let's do all these, strangles and synthetic strangles. I want to make income just like everybody else, but part of me still has like such a thought this year that it's like, look, I would welcome a bit of a correction. But all I would use it for is a chance to get trades going lower. So, for example, I think what I'd like to do is kind of position if I did the SPY, the Qs, the Dow, the Russell, and then I look at some futures market, I could do E-mini futures, E-mini NASDAQ, E-mini Dow, E-mini Russell. I like all those trades and it gives me a quantity, but I'm essentially looking for, if I can, and futures contracts are different, but I did put on a broken wing butterfly today on the Russell. So RTY is the symbol.
upside or
So that
downside.
it's a broken wing butterfly. I'm doing puts, so I'm trying to position it lower. Where if the Russell were to fall, and my position is, I think I did a 1900. Let me check there it is. So my sell, 1875. So I have the Russell here, -2 at 1875, +1 at that'd be 1900, and then the skip strike at 1825. So I collected $1.15 credit with a 10x in the peak. So 1875 is my level where if the Russell were to drop, and let's percentage that out. So if we drop to 1875, we'd have to see a drop of about roughly 8% in the Russell for me to be threatened on my position, or not necessarily threatened, but kind of perfectly playing this. If we did drop 8%, I'm going to get, hopefully turn $1.15 credit into like a $10 credit. Now that's wishful thinking, but you never know. I did this trade out, I believe 60 days. Let me check the expiration. I went to August 16th, 52 days out. So I was looking between that like 45 and 60 day window. Obviously if price just stabilizes, and this is where I'm torn, because like I would like to just sell here, and just trade, and get all the credit up front with a strangle. So if you want to, I'd like to look at that, because if I thought, I guess I'll just go out a little bit. Let me go out like 20 to 30 days. I don't see the market changing a lot over the next 20 to 30 days. I don't know about you, but if I looked at a trade here and I go out, let's say 31 days to July 26th, so before the end of the month, and I look at the Russell, the expected move is around 2,100 to 1975. Let me see. I wish there was a way to scale that a little bit more to know exactly what that is, because those are 25-point wide numbers. I mean, it's not the SPX at 5 points wide. This is 25 points wide. So let me see what this looks like. And I do know that, safely speaking, going to like the 1900 zone or lower would be pretty nice. And the expected move, I mean, we shouldn't get, based on this expected move, we shouldn't get to 1900. That's an 11 delta. If I did like a 1875, so similar to what I have right now, and on the upside, if we don't make recent highs at 2175, let's see what that looks like. 2175 is, I mean, dude, I can do an 11 delta on both of these. Okay, so
is that $10 credit?
Yes. So, and again, because it's a futures contract, you're getting like 50% of that. So 1020 credit is going to be $500 max profit. So 510's max profit. Now a strangle, of course, is undefined. So if price goes above or below, that's unlimited risk. Either goes to zero or goes to infinity. That's unlimited risk. So what I think I'm going to look at is, how much credit do I lose if I turn this into a synthetic strangle? So right here, you can see my buying power reduction. This is on a IRA account, is $8,700. If I take this to a margin account, let me take this down to a margin account. This should cut the risk in half, or the buy power in half. Yep. So I go from $8,600 to $4,300 for the trade. Still collect that $10 and change up front. Now, I don't mind this trade. It's only 30 days out. I think this trade is totally safe. But to be even safer and to make this cost me even less, I want to see how much credit do I lose if I did like 20 to 30 points wide. So 2175, let's say, to, it's already, each, geez, Pete, I guess I'll go 50 points wide. Okay. And I'll shave down the buying power, but that cut about $2 and change. And I went 30 points wide. So I go 75. I can't go 30, or I'm sorry, 50 points wide. I'll go 50 points here as well. So, okay.
Yeah, we got to keep in mind too, this is Russell.
This is a Russell's futures trade. Yes.
This is heavy interest rate sensitive. We have this whole month, we have our monthly CPI data and FOMC at the end. So I guess there is that to account for, unless you're kind of looking for a way to get out and collect some credit before that happens. I think when is the next CPI number?
What have we navigated in the Russell? Like, look, this is the Q4 rally of last year, right? That was your big rip of 30+% where the Russell outperformed everything. I mean, the Fed narrative, the interest rates, the CPI, the PCE, the blah, 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 like, it's all been out there for 6 months, dude. What has the Russell been doing? Nothing. So how much more sensitive is it? How bad would the data have to be for the Russell to be like, oh crap? I mean, is the Russell going to drop 8% while the Dow stays steady, or the S&P or the Q stays steady? I mean, I understand that if we drop on the SPY, drop on the Qs, then the Russell's maybe a little bit more sensitive. This trade's obviously not perfect, but let me show you my trade. If I turn this into a synthetic strangle where I'm going 50 points wide, yes, there's still risk on the trade, okay? There's still risk on the trade. But if I take this trade now, the buying power reduction went from $8,700 to $700. I can take this trade for $700, okay? Now, my risk on the trade is $2,200. That to me is about 1% or slightly less than 1% of every account that I'm trading. So it's a 1% risk if I'm dead wrong, which means price would have to go all the way through the expected moves for this to be a trade that doesn't work. Okay. Now I can still collect $5.20, which if I cash that in by expiration, I'm making $260 of profit. Now, going out 31 days, I don't necessarily have the ability to manage this at like the 21 DTE. I think this would be something, if I'm going to take the trade, I've got to manage it basically at expiration. So I think I'm going to take this trade. It's not a lot of buying power. If I do this in a cash account for my IRAs here, this IRA account, you can see it's only a reduction of $1,300. Frank, if I make, $265, let me just do the math on this for the buying power. So if I have to put over $1,375 in buying power and I make $260 out of that, I mean, I'm making 18.9% on this position. Now I could make a lot more than that as percentage wise, but I'm taking up way more buying power, which I'm always conscious of with these accounts. So like I said, if I were to pick, I would almost rather just play the put side and not have it strangled, right? But if the Russell for the, I suppose this, what would it be about June or July that gets this market to go anywhere? I'm just asking.
What's that same? Sorry, wait. Ask that question again. I have a question too.
Okay, my question was, what is it about July? Like we're about to wrap up the quarter, right? Wrap up the quarter, get into Q1. We have a holiday week during July. We have a new round of data. I get but the Fed's not until the end of July. This trade, if I took it, would, yes, deal with some news, right? But the Fed would be end of the month, July 31st, which is actually going to be after this expiration. So if I did hold this, I'm well outside the norms of the expected moves, which I'm okay with. So again, mechanically, it's an 80% chance of profit, but outside the expected moves, it's probably slightly higher than that.
How many points is that again? Like either way, I can't really see.
From current price at 20, let's just call it 2050. We'd have to go about 80 points down or about 85 points up.
Gotcha. So there is news. There is the CPI. And the FOMC is until the end of the month. So unless we see a crazy number, like you said, it probably won't move that dramatically.
Yep.
If CPI changes, but what would that same trade look like going out to the 12th
of July? Okay. I'm going to take a screenshot of this one because I think I'm going to take this trade. I like this trade enough. Or I could position this with a broken wing butterfly. Maybe that's better. IV is a little bit higher. So let me do one thing. I'm gonna get rid of this. I just have a screenshot of that. So if I went to a broken wing butterfly, let's look at the deltas. If I did, let's say 1900 and then a skip strike, there, and then turn this 1900 into a 2 contract trade. I mean, the difference between $5 a credit and 40 cents. It's like so this 50 cents credit, don't get it wrong. 50 cents credit on a futures contract, I'm going to make like $10, dude.
Yeah, it's not good.
It's not exciting, right? Or I guess you're making like, $10 to $20. Now it shows max profit at $12.75. That's only if price were to come back and hit 1900 by expiration. So a broken wing, even with a 33 IV rank, is just not paying me enough to make the credit that I want. I'm better off doing it on the IWM than I am doing on the Russell's contract. In a buying power, it's crazy. It's the same buying power if I did it both ways. Do it. So anyway, you want to say what was the date? What was your expiration?
The 12th.
12th.
Or
okay.
If it doesn't show up on there, I'm looking at Fridays in July. So
okay. So July 12th is there. July 19th is there.
Yeah,
July 19th should be monthly.
Do the 12th.
To the 12th. Okay. So let's base it on. So the reason I also base it on my chart, right? I see this. If we're safely putting our strikes below 1900 and we're safely putting our strikes above 2170, to me on the chart, that would be where I'd like it to be, right? Like I don't want price to come back down here and I don't want price to come back up here. I just want price to stay in the middle. That's how I make full profit. So let's take a look at your, I see the questions coming in the chat on the Swiss. We can highlight that before we're done today. So let's go. I said what, 1900? So right now, if you did this, Frank, that'd be a 6 delta on the downside. It's super high probability, but you're not going to collect a lot of credit for it. 1900. Now, I take that back. If we did just a strangle and it was undefined, a 1900 by, let's say, the 2170. Okay, so a 1900 by 2175, you can grab almost $5 of credit there. Again, this is the issue. $5 of credit's great. Profit's decent, but the trade-off is you're going to have to fork over $8,900 for that trade. If it's naked, right? If it's a sell call, sell put, no defined risk, no spread, you're just putting in way more buying power. So that's the downside. Now, if you make it synthetic, let's go 50 points wide. So I add the buy leg.
Condor? Why are we calling it a synthetic?
It is an iron condor.
Why
well, because
synthetic?
This is why. Because what am I actually trying to do here?
I mean,
what's this? What's this? This is a strangle.
But that's what condors are for, right?
Yes, but the reason it's kind of synthetic is because I want the strangle. I don't actually want an iron condor. An iron condor by nature is like tighter spread, so it's like you just go one strike out and create the spread. So because I'm going farther out, so let's say this. Let's just say I did 100 points wide. There's no way that I'd take a credit spread and go 100 points wide because that's crazy. But what I want is I'm trying to get as much profit out of this trade. But look at the difference between. I'll delete this. So this trade, as is with an undefined naked strangle, is almost $8,900 in buying power reduction. If I do a $100 spread there, and I do a $100 spread here, there, I just went from $9,000 in buying power to now $3,000 in buying power. And I only chipped away at my profit by about $50 to $60. So I'm getting the benefits of having the sell call and the sell put, but I just have it where my buying power is now cut in half or slightly more than that. So that's the benefit of like going wider. You can call it the same thing. You can call it a wide iron condor. Again, I could care less what these option strategies are called because they're stupid names. But it's the same benefits of trying to do a strangle, but I want the defined risk so I don't have like crazy unlimited upside and my broker doesn't tie up $9,000.
Well, this is a shorter time frame, and instead of 5, it's 3. So
instead of 5, it's 3. Yeah. So instead of if I delete this, it was like 490, correct? So instead of 495, if we did a buy here and 75, if we buy here, so we went from 495 to 355. Okay, so you sacrifice $1.30, $1.35 in profit. You still haven't. I mean, look at the POP here, dude. 87% chance of profit, Frank. That's pretty darn good if you ask me.
I like that more, I think, because that I would say you would close that before expiration. You'd probably collect maybe $1.50, $2 in credit. But this expires on the 12th. The 11th is CPI data. If you close before that Thursday or whenever the 11th is, maybe you could collect a good bit of that. Maybe you could get like 80% of the 360.
Maybe because we're not going out a ton in time. The one thing about selling options is if you go out for a reasonable duration, that theta decay, it works in your favor with a slightly higher DTE. So if and again, I like this trade as is, but I'm probably not going to, if I get this from 17 days to expiration to, let's say, 7, this is probably still trading. If we've had like a little bit of movement here, a little bit of movement here, this probably isn't budging too much. But if I went out, let's say to my, my 40 or my 60 days to expiration, and we get down to 21, right? We've all of a sudden cut half this cycle down. And that's where like the theta decay waterfall happens, where you can suck out most of that premium. And a lot of times that 50% take profit is hit a little bit sooner. So
you don't think you can collect $1 in credit after like a week?
It's very possible. But remember this, because it's a futures contract, $1 credit that would normally be $100 is going to be $50. Still, so I mean, if you did $50 and you made that in a week, that's still a good trade. That's fine. But to make $50 and tie up $3,000, that's not great. Just my thoughts.
Oh, so your max risk is $3K.
Yeah. So your max risk is more than that. Your max risk is $4,800, but your buying power reduction is $3,000.
Oh.
So that's why a little duration wouldn't be terrible. But my point is there going to be a major catalyst to dump the markets in June? No, the month is ending in 3 days. Is there going to be a major catalyst in July? It's like the typical summer month. It's like, what bad stuff typically happens in July when it's historically bullish? Not much. It's usually like what's been put in motion stays in motion, and July is usually a slower month. I don't know. Maybe we have a catalyst with all the news and it's low volume, and maybe the market gets rocking and rolling. Dude, at the end of the day, there's risk in everything that we do, right? So I think that the Russell has exuded a lot of indecision. And I think it stays that way until the market as a whole decides that something better or worse is coming, right? If everything is better, then the Russell has all the potential to be one of the best performing indexes to play catch up. If something bad happens, the Russell has all the potential to be sensitive to interest rates, and we could drop all the way back down to these lows and just maintain this ugly, nasty range. But if nothing happens, and again, mechanically speaking, I looked at this trade that you just created at a 6 delta, dude. A 6 delta is actually a 94% chance of profit on the trade to finish out of the money, which is exactly where I want this trade to be. So it says 87 here, but technically with the deltas, we're at, a 94% chance of profit. So
what about doing, you're talking about doing this on SPX daily?
yeah, I did it this morning.
What about Russell on the daily? Is there just a difference, or like, are you doing this every day on the SPX? And
yeah,
so you're closing out intraday?
Yeah, so the reason I wouldn't do it on the Russell daily is look at how wide these spreads are. This is a 25-point wide. So I don't think the Russell has every day, right? Yeah, so this Russell only has this is 3 days, 10 days, 17. We're going weekly expiration, so I wouldn't do that. I would just look at the 0 DT for the SPX. And also the spread, like look at this week's expiration. See how these are 10 points wide? 10 points wide, sometimes 5 points wide. The SPX is just like super liquid, and it's always 5 points wide. So I did that this morning on the SPX, and I centered the trade around I think price opened up around right here. So price opened up around 54.55. The trade was at $2. Where's my 0 TTE here? The trade was at $2.85, or the trade, if I went a little bit tighter to price, was at $4. Already the trade's in profit. Already. Okay. It's 11 o'clock. It's been 90 minutes of trading, and you've already made $45 or $60 between the two trades, depending on how tight. So if I did a 15 delta, I made $45. If I did a like a 20 delta, I made $60, and I did that within the first hour trading.
What about,
so this one's profitable, 45.60 win-win. Yep, these are good. I can track these.
Letting it expire though. Say you do it one day out. Do you think that if you were to take it, I don't know, at the end of the day or something, if you did like a synthetic strangle on the SPX, and you did it one day out, so you start it at the end of the day, and then you see wherever it is in the morning. Have you noticed any gaps in your trades that would suggest that it's out of your range, or do you think that it's been relatively stable? Like it'll stay in this range for longer than a day or so?
Well, I guess if we have a news catalyst or a gap, like right now, price action wise, we're not getting really a lot of anything, right? Last week's move, Monday was up, Thursday was down, Wednesday was a holiday, Friday finished right where we started. So the week was a nothing week. But we don't know that, right? I mean, the week last week from this low to this high, I don't think was a full weekly trading range. The low was around 541. The high was at 550. You have a $9 week out of an average of 10.5 to 11. So most of the weekly trading range was hit, but just on volatility. So you're asking if I did this like one day out?
Yeah.
Okay. So let's look at it. Let's say, so this trade is done. This trade's already, I'm curious if I'm trying to think. This thing has already decayed $1.40, which is about 50% of the take profit. That's awesome if you get a 50% take profit, or even more so. What's $1.50 out of 40? Let's go 1.5. Oops. 1.5 out of 4. So you've had so 63% decay and a 50% decay in the first 90 minutes of trading. That's pretty awesome, dude. Like, and again, it's because the market's cooperating. We're not having crazy movements directionally. Because I will say this, and I've watched this, Frank, and this is the bad part. Like, it's not just like, oh, tell me that strategy. It's amazing. If price were to move directionally and it comes up and threatens your position, if I took a $3 credit this morning and it moves towards one of your strike levels, it's probably trading for like a $6 or $8 or $10 debit. That's a big loss, right? Now, it's not unsustainable. It's not ridiculous. You're not taking a max loss, which is around $1,700. So, my determination for this trade is I probably have to close it by, noon or 1 o'clock. And don't and just get over the fact that like, oh, if I were to hold it to expiration, it's full profit. But it's not worth that potential gamma risk you have late in the day when all these deltas or all these Greeks are so sensitive. So anyway, let's reposition this. So let's go to right now. We're trading at 54.57. Let's just say 54.55. Okay, we're gonna say that's gonna be our center, and we're gonna go out to tomorrow. To your point, all right. Tomorrow, Wednesday, 54.57. Now look at the weekly trading thus far. This is why I wouldn't love going out, tomorrow or the next day. I just try to treat it the day of. But this trade for the week has only moved about 45 points or so on the SPX. So here's my SPX from yesterday to today. That high to low has moved about 43 points. Okay. So let's say that last week's low, last week's high is still going to be safe and the price doesn't really want to do anything. Let's see how this trade would look tomorrow. So if we center this thing around 54, let's say 54.60, because we're 2 points off that. So if I'll say 54.60 is my center. I go out. What's kind of nice about this is, the IV is not great. It's at 14. But if I did the highest probability for tomorrow, Frank, I would say like a 10 delta or lower. Let's look at the credits. It's not going to be a ton here, dude. There's going to be a lot of risk here, but let's look. So if I did a 10 delta and I sell the 10 delta, so right there, and then I go to the put side and I do a 10 delta, there's an 11 or a 9. I'll do the 9 just to, maybe 2% more in profit or percentage of profit. Okay. So right now, if I did this for tomorrow, I can do a naked strangle on the SPX. I'm only going to tie up $541,000. So obviously I'm not going to take that trade.
Pretty good.
Pretty good, right? Just a little risk. But I'm going to synthetically, add the spread. So now 5,500, if I went out 20 points there, okay? Or I can make it wider, but you're going to see the risk change. So 5,500 to 5,520 and 5,410 to 5,390. Now I just reduced it down to $1,700 is my buying power reduction plus my max risk, but I can make $220 if I take the trade right now and this direction stays where it is. If I took the trade, you're talking about this maybe end of day. Is that fair? Like you'd want to take this kind of late in the afternoon and see if the market's going to open about where it closed?
Yeah, pretty much. Just because the 0 DT thing is not like something I can do.
Sure. So if I took the trade now, I take that back. If I took the trade, let's say today at 3 p.m., okay? And let's talk about this in offline too. I will look at the trade today at 3 p.m. and just put it in hypothetically. I'm not going to take the trade because obviously I want to build, some track record with this. Like I like the SPX 0 DTE. The market's been cooperating. Price has been quiet, and I'm not going for big profit levels. I'm going for like 15%ers, for 15 to 20%ers. What I'm noticing is it's amazing how fast price moves. You and I talked last week. We had a couple of calls, right? We watched that thing drop like 40, 50 cents in like the 30 minutes that we were talking. So you know how sensitive and how really great it can be to like suck out that premium right away when you're selling. So if I looked at this today at like 3 p.m., take the same type of idea, position it for tomorrow, you get time in the trade, which is great. What you need to have happen, of course, is you need price to essentially open where it started to close for today and not have any crazy gamma exposure late in the day. And that'd be my only concern about taking it late in the day. So, if it was like I took the trade at 3:45 p.m. or took the trade at 3:50 p.m., that's different than taking it at 2:30 or 3 p.m. That I'm telling you, that 1 hour before close, there can be some weird stuff happening. A lot of that like crazy pump volume goes in late in the day. and it can mess up your centeredness a little bit. So long story short, what was the difference here? If I delete that leg and I delete this leg, so you can collect $3.20, or you can go 20 points wide and collect. So you're losing $1. You're losing $1, but now your buying power reduction is infinitely better, right? $500,000 in buying power to now $1,700. So obviously this is a manageable trade. Your credit, $2.30. I mean, if I go after, let's say, a 25% take profit, okay, so 0.25 times 2.30. So if I did this trade and I suck out my 25%, I'm going to make $57 on the trade. It's a little income play for the week. You know, if I did this in, I mean, right now I started tracking this on 6/17. 1, 2, 3, 4, 5, 6, 7, 8, 9. 8 wins, 8 wins, 1 loss. And this study has been going back to what peaked this study was a Tasty Trade 52-week study of the SPX. It averages about 91 to 94% wins. Now, what I wanted to know, and this is why I'm doing it on my own, I wanted to know, if we're taking losses, how big are those losses? So the nice thing is I can trade this crap every day. I can go into my options platform here, and I can actually test this with an options replay feature that I have that has data all the way back to 2011. So I can test the crap out of this thing. And zero DTE has been around since 2022. So if I want to go day in, day out on the SPX, I can trade this. It's going to be a lot of work on my end to like build up every trade, but I can do it. What I can't do is I can't see mid prices and I can't see intraday prices. So either, and this is my result, the trade, and this is where Tasty is really nice. Tasty has data every 10 minutes. Okay. I have daily data. So if I did the trade, it's either it wins in the day, full profit, or it loses on the day, full loss. And I see what those numbers look like. Because again, if you're taking partial profit, partial losses, blah, blah, you don't know what the numbers add up to be if I can't see the data. But if I did full loss, full profit, see where the numbers stack up. If I still average a 90+% win rate at full profit versus a full loss, if we have a 90+% win rate, we're still going to make money. Should, again, conceivably. So anyway, I know I have a lot of work to do on the testing side, but I've been watching this. It's pretty impressive because right now seems like the perfect window to do it, right? It's like things are kind of slow. Things have slowed down. The market peaked out at, 550 on the SPY. We're struggling. We're stalling. Not struggling. We're just stalling, dude. It's like we might not have a correction, Frank. We might just have a freaking pause, and a pause is great for the strategy. A pause gets me, easily 40, 50, $60 a day. That adds up. I bang this out for a month and get 20 days of trading. I can make a couple $1,000. So, and price didn't go anywhere. But anyway, but like I said, I want to verify. I want to make sure that, yes, I do have a high win percentage. And yes, I'm not making, a trade where it's like, cool, I made, $50 today, but my max risk is $1,750. How many wins do you have to make that up? If I lose $1,750, but I win $50, okay, I need to make 35 winners in a row to make up for one full loss. That sucks. So that's not a strategy that I really love, right? I'd like to keep that where it's more contained, where maybe my average loss is in the $300, $400, $500 window as opposed to $1,700.
Gotcha.
So anyway,
again, what are the odds that you have to take that loss?
That's the point. That's my point. Is like the odds are slim that you're going to take a full loss, because what essentially has to happen is price has to go well beyond the expected move. And most of the time, two things. Most of the time, the expected move is over calculating what the market higher IV rank. You can get more credit up front for going further out in the money. That's the nice thing. If we have higher IV, dude, I could do this with like a 5 delta and just try to stay the heck out of the way and get that credit and get more credit for it. The closer you get to like the 15s, the 20s, the 25s, the 30 deltas, yeah, you collect a lot more credit up front, but you put yourself in harm's way with those probabilities. If you did a 30 delta, all you need is a 1 standard deviation move to test, and you're in trouble. So that's why you like going out to that like 2 standard, 2.5 standard deviation moves. That way it's not an issue, right?
Yeah,
that way most of the time the probabilities are in your favor.
If it starts to move heavily against you, you could always just close out too. Like you're at no
absolutely
obligation to hold for longer than however long you want to hold. So if something is moving and you're not comfortable holding on till the end of the day or waiting for it to settle down,
Yep.
you just take, instead of that $1,700 max loss, you could look for like I don't know, you could end with like a $500 loss. I don't know.
Yeah,
But
I mean, my soft rule on this is by 1 p.m. I'm out of the trade regardless. By 1 p.m. Because if I go from 2 p.m. to 4, or 1 p.m. to 4 p.m., I bring in all that potential sensitivity on the Greeks. I bring in all that gamma risk. And, if it doesn't get there by like right now, most of these trades, I'm noting this, take profit hit by 10:40 a.m., take profit hit by 10:50 a.m., take profit hit by 11 a.m. Like that's what most of these trades are. So if I waited longer, it's because maybe price early in the morning, tested my levels and I wait for a little bit longer. But as long as we get enough like theta decay or time decay to work when we sell the options. So just as we've been talking in the last, 10, 15, 20 minutes, notice how this was trading at $1.60. Now it's up to $2.45. Why?
the market's
Because
higher in the
price has
past
been
like
moving up.
10 minutes.
Yep. So look at how sensitive that is. So when you get your profit levels, you take the profit. So that's why you just kind of set a rule. It's like, do I like the 15%? Do I like the 20%? Do I like the 25%? Just take it. That lowers the volatility overall in the trades. That's more consistently hitting profit targets with higher probabilities. And that's how this has like that 90+% win rate. Yeah, because if you waited all day, you're bringing in a lot more sensitivity where this, $2.85, if we get a big day like this, if it even comes close to 5,500, this could be traded for $6, $7, $8 of credit or debit rather. I mean, you could take a 285 credit, be upside down 100%, which never feels good, right? So the idea is get in, get out quickly, easy, achievable profit targets. Go to the next trade. So it's pretty cool, man. I mean, it's something for me to track and do. It's something for me to watch. I still want to put in my testing. I've got the platform to go back. I'm probably not going back to 2011. I'm probably going back to like 2018, 19. So I want to get like 5-6 years of data under my belt with a bunch of strategies. We talked about the reverse iron condors. We talked about the kind of that like straddle debit spread. And this one's a good one too. And I could do 0 DT since like 2022. Like I think summer 2022 when 0 DT happened, which is fine.
Cool.
So anyway,
well, I'm interested to see how that pans out on your test.
Yeah. So I keep like leaning out. I just want to get comfortable, man. All right. I'll wrap it up here. I gotta jump into my other trading room here. For everyone watching today, sorry we didn't get to a bunch of requests, but I do know, like, I'll just give you a Frank, if you want to bear with me for like 1 minute.
Sure.
I am still indecisive on the dollar. Okay. So the dollar, DXY. We talked about this a lot in the show. The dollar is right at my bullish resistance zone at 105.60. It's just not as convincing as I'd like it to be, and I don't think that it has to be. If this market's going to be choppy and slow for the summer, the dollar is either going to just make these like subtle little grinds into bullish territory, or this dollar doesn't want to go any higher, and it's going to be a range trade. And the range is right here. This high, this low, this is the dollar chop. If we don't want to go anywhere, I'm not really exposed on a lot of dollar crosses. I'm short euro dollar, I'm long dollar CAD, I'm long dollar Swiss. That's it. Pound dollar's garbage. Aussie dollar, New Zealand dollar, garbage. I don't like the way they look. They don't want to go anywhere right now, so I'm staying out of them. The dollar yen, what do you want to do when the yen crosses? Somebody asked me that earlier. I said 0, nothing. The only thing I'm doing on the yen is trading this. I'm long the FXY. That's it. I'm down about 50 cents on the FXY, as opposed to being down hundreds of pips if I was trading the longer yen and getting charged every day for negative financing. So my exposure is light. I think the thing you have to watch in the yen crosses would be if the dollar yen revisits 160 and there's a reaction to that. Okay. If we hit 160 on the dollar yen and there's a reaction to that, then this is clearly an important level that the market's going to continue to pay attention to, right? This, for example, draw a trend line. Let me use a straight trend line here. If this level reacts, watch out. If this market is going to just coil and wait and go nowhere, let's say that we have a little reaction at 160, but then it just tightens up. Look at this. What do you do with this? Well, either we break and have like this big rising wedge, or this thing blows the top off and we just get another 1,000 points weaker. I'm not sure. but I don't like the yen for this reason. Okay, I think the yen is better in 2025 and 2026. I think it's better when the market's ready to deleverage and rotate, and we see a big shift in monetary policy where the attractiveness of a carry trade is not as popular. Right now, the carry trade is strong. Right now, we have 0% versus 5%. Who wouldn't want that swap every day, right? So anyway, yen crosses are tough. Dollar pairs are tough. I'm still long against the Swiss. Yes, Zen's asking about the Swiss. Not Swiss long. I'm long against the Swiss. Okay. Aussie Swiss, I'm long. CAD Swiss, I'm long. Euro Swiss, I'm long. Pound Swiss, I'm long. New Zealand Swiss, I'm long. Dollar Swiss, I'm long. Not trading the Swiss yen. Why am I long against the Swiss? They just cut rates again to 1.25. I've been long against the Swiss since 2023. It's one of my favorite technical trades. I've said that for the last year. So I'm in it. My currency trades, I only have like 11 currency pairs that I'm in. 6 of them are Swiss pairs. The rest are just little dabbles. I'm in Aussie CAD, New Zealand CAD. I like those, bullish. But yeah, anyway, just a little short recap on what I'm doing directionally for these currency pairs. But I'm getting paid to hold my positions against the Swiss. I like the Aussie CAD, New Zealand CAD directionally and technically, so I'm long on those. And I'm still looking to add a bunch of positions on my Swiss crosses because that's my investment basket right now. I'm trading, I probably have, I don't know, dude, 70, 80 positions running on Swiss crosses right now. Small, but built up a position pretty nicely, and I'll keep adding to it. Can I show pound Swiss? Sure, and I'll wrap it up. And then equities on demand students that are with me, I'll pop over in the trading room in about 5 minutes. Pound Swiss, I like this. It's just a swing, right? If we have this low, we have this high. Either we break the trend line and continue to go higher, or we have high, low, lower, high, lower, low, and then set up some type of harmonic pattern. And I'm buying the heck out of the pound Swiss down here. I'm trading it to 120. So I mean, if everyone wants, like, Chris, what are you doing right now? I'm not buying this and putting a stop loss here. I am buying this thing here, 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 here. I'm all over the place. But I'm positioning for, I'm dead wrong down here. I will give myself all the breathing room to position for, I will accumulate in this area, and that's my destination. This is where I take profit. Right now, I'm just managing positions. Small drawdowns, manageable drawdowns. But what's nice is when you catch a trend, when this market does make a run to 120, guess what? I can add to this position. I can add to my winners, and I turn what is, a manageable, let's say like 3% risk into maybe an 8 to 10% profit. That's what's nice. So I produce this asymmetrical profit by building small and then getting the trend to confirm over and over again for me. So just a little style that I have. I do have a couple examples that on my YouTube channel if you want to check it out. There's some like trading 101 video series that I've done and keep it seriously simple. So one of them was called like adding to winning trades, and it's pretty much this in a nutshell if you're interested. So Frank, any final words, any parting thoughts?
No, not really.
Okay.
Nothing for today.
All right. So the trade that I looked at this morning on the SPX, we've already seen another 30 to 40 cents of fluctuation in our favor. So like I said, when we looked at it 20 minutes ago, it was down to 160. You're out of the trade with like a 40, 50% take profit, or just get out earlier at that, 15 to 20% take profit. And that's what I've been tracking here. 8 out of 9 winners for the last couple of weeks. And what I'm noticing, a lot of the winners are done by like 10:30 or 11 o'clock. So if you started trading around 9:30 or 9:45, within the next 90 minutes of trading, the trades are pretty much done to your profit targets. So good stuff.
Yeah, something to look into for sure, because when the markets aren't really moving, I kind of want to play that side too. Just need a slightly larger time frame.
Yep. Let's do this, Frank. Let's talk a little bit more offline. I don't know if you've used Bollinger Bands, but I would be interested to see if we could have this conversation more. Maybe have some technical indicators to go with it. I know a lot of traders that do strangles, especially, are looking for like the narrowing and the expanding of Bollinger Bands. So that could be one thing we look at, is trying to find. I've got a couple videos that I'm reviewing on, there's ATR contractions and there's Bollinger Bands and things like that. So that might help us give an idea of when things are sideways. The good part is when things are sideways, it's a great time to do trades like this. The bad part is when those things start to open and expand, you don't want to be stuck on the wrong side of it with a strangle, right? So I mean, and this is why I've just never loved like long-term strangles, because if the market has a positive drift, which means if I mean, what's the direction the stock market's supposed to go? For 70 plus years, the stock market's had a positive drift where it wants to go higher. So there's an interesting study on the test of your levels or the close of your levels, and the put side is way less tested, and the put side is way less closed in your in the money. So if you really wanted to have the most consistency, you should never put a strangle on with a call, and really you should never add a covered call if you wanted to be the most consistent, let the things run. But we know that covered calls are great to lower your cost basis and get out of trades and get the stock called away. I mean, every trade I've got called away from this year has been with a covered call, and I'm fine with it because I book my profits. But anyway, there's always trade-offs, man. That's what's crazy about this market is like, but the reason I love options is you can make your trades very mechanical. Here's the trade, here's the numbers, here's my credit, here's my risk, this is my probability. You know all that going into your trades. All of you out there watching this, if you're traders, there's nothing about trading that's just like random. If you want to be a good trader, it's all about probabilities. Have a good setup, see a pattern trade out over and over again, have all the numbers and the math work out where it's like, this has X amount of percent. This is a reward to risk that makes sense. If it doesn't, then you're just guessing, So everything should be pretty tight, pretty mechanical. It's always risk, always reward, and just trade over and over again. The best thing you can do is be here for the next 5 or 10 years as a trader and figure out that you've survived and you make some money. Market's not that hard if you give it time, right? It's hard if you're trying to be right today, right? Frank, if we had gun to our head and we had to be right today, it's harder. We give ourselves some time. We have room to let the market do its thing. So,
yeah.
All right, dude. I'll stop my rant.
All right, Chris.
Bye for now. All right, thanks, Frank. Thanks, everybody.
We'll
See
talk
you.
about this. We'll talk more tomorrow or Thursday.
Sure. Sounds good, dude. All right, see you, man. Thanks, everybody.
Yeah.